Good afternoon, everyone. Welcome to Policy Exchange. Really good to have you all here today to see sort of one of our central events as part of our financial services program. I'm very pleased to welcome Professor Jim Hines over from the University of Michigan, where he's Professor of both economics and law. And he's recently released a paper talking about sort of offshore financial centres and whether or not these are actually a boon and they can actually promote and encourage growth amongst sort of national economies, or whether they are actually effectively robbing the tax base from all of these places. I'm sure you'll be aware that it is kind of quite a politically sensitive issue. The OECD back in 2000 listed, I think, about 44 basically states on a blacklist, and which recently, last year, I think March 2009, with actually the final 3 were removed from it, perhaps suggesting the sort of increased transparency, accountability. But it's very important for us at Policy Exchange to approach all these questions in such a rational way as we can, not jump to immediate, intuitive conclusions without really having as much evidence behind them. And hopefully Professor Hines will give us a lot more sort of clarity on that today. We're going to have a sort of speech where Professor Hines will outline his things, and then we'll have a Q&A afterwards. I'll be very interested to hear your questions. So, Professor Hines.
Thank you very much, and thanks everybody for coming. You know, I've been working on this set of issues for more than 20 years now, and I will say, when I started, it was a lonelier business than it has become. Economic changes around the world and political changes around the world have increased the salience of these issues, and I think many people would acknowledge, you know, they're potentially very important for economies really throughout the world. So to clarify, there's a document in the back that is a report that I did for the Society of Trust and Estate Professionals. They approached me about a year ago and asked if they'd noticed that I had done a bunch of research on this set of issues, and not only I, you know, a number of other people had as well. And would I be interested in writing a summary of what we had learned from the quantitative research about the impact of international financial centers on other economies? And I said, sure, I'd be delighted to, because I had the impression that, oh, you know how it is in the academic world, you do these studies and they tend to be read by a dozen specialists, you know, and it doesn't really, the results, however compelling they may be, don't get out to a broader audience. And I thought it would be beneficial to have more people informed about what we've learned from looking at the evidence. And so that's the purpose of the report, is really to bring to light to many people the research findings that have appeared in the literature. For those who are interested in the footnotes and things like that, there are references in the back of the report, and they are to long, dreary, rather technical academic publications, but the results of which are described, you know, in some detail in the report. So that's what it's about. I mean, the substantive question is, what is that the report addresses, and that I've been working on, is what is the impact of these low-tax international financial centers on economies elsewhere, you know, other countries. And the quantitative research really points mostly in one direction. And I would say very strongly in one direction, which is the positive impact that these financial centers have on economic developments elsewhere. What is the nature of this evidence? What we find is that countries with transactions with international financial centers, ones that are close to them and have lots of, you know, flow with them, economic flow with them, wind up with higher direct investment levels, which, you know, leads to greater investment in plant and equipment, greater job creation. You have also more portfolio capital investment. So capital is coming from these international financial centers into the, you know, high-income, high-tax countries. You have this capital flow, which, you know, contributes to the development of these economies. Interestingly, you have things like the financial sectors of nearby countries wind up more competitive if they're proximate to these international financial centers. You can readily forget this if you're in the United Kingdom or the United States, but most of the world has very underdeveloped, typically government-owned financial sectors. You know, governments own most of the banks in the world. That was true before the crisis. You know, after the crisis, things have changed a little bit, but even if you roll the clock back 3 years, governments own most of the banking sectors. And as a result, they wind up, not surprisingly, much less competitive than in cases where you have private competition in banking sectors. So again, if you look around the world at the evidence from, I don't know, 5 years ago, you'll find that in the countries with government-owned banks, you'll have very large spreads between borrowing and lending rates. You have small numbers of banks. You have very little financial intermediation in these economies. You have significantly underdeveloped financial sectors with all the problems that that creates. Basically, it's very hard for these economies to provide liquidity. It's difficult to provide investment capital. There are a lot of problems when you don't have a thriving financial sector. And I just want to emphasize that if you get outside, you know, the confines of Europe and North America and into the bad world out there, it's really, really underdeveloped, significantly problematic financial sectors. Well, what is the role of these international financial centers? They are not underdeveloped. They typically do not have government-owned banks. And they provide capital and beneficial competition for countries that do have limited financial sectors. What research has found, this actually is not my research, but others, although I've looked at the evidence too, and I agree they've correctly analyzed it. What other researchers have found is that you have lower interest rate spreads in countries that are close to international financial centers. You have more banks per capita. You have more active competition, basically because the international financial centers are providing this, you know, potential source of competition that then has beneficial effects on other countries. And you know, it's certainly true that the banking sectors and the financial markets have taken a battering in the last 2 years and have earned a not entirely favorable impression of late. However, try to imagine life without these institutions. You know, unfortunately, we got to find out in October of 2008 what life is like when these institutions are not providing credit and liquidity. And it's not a very good life for an advanced economy, or really any economy. So these international financial centers are serving the function of providing capital market competition that for a lot of the world is highly beneficial. What about tax revenues? Look, I don't mind, I'm a tax professor. You know, tax economics and tax law is what I teach, and that's what I analyze, are tax systems. Should we be concerned that international financial centers are eroding the tax basis of other countries? It's a good question. There's a lot of evidence on this question. And as I say, I've been writing about that question for 20 years. So what are the issues there? The concerns are the following. There's concern that taxpayers will reallocate taxable income from high tax jurisdictions to low tax jurisdictions, and thereby, you know, strip out the tax base from high tax jurisdictions. And that's a realistic concern. The counter to that concern is, well, in what sense could the existence of these international financial centers contribute to the tax base of high tax places? Well, that can happen too. And the way to think about it is, you know, partly if you facilitate investment and other economic transactions, then of course that generates tax revenue. But the other piece of it is that it's a mistake to think in terms of the world as we see it versus a world in which you didn't have international financial centers, but that nothing else would change. Because that's not the case. If we somehow, I don't know, waved a magic wand today and eliminated transactions between international financial centers and the rest of the world, what would happen? Well, one thing that would happen is that it would greatly impede the ability of international investors to do certain kinds of transactions that wind up with investment in high tax places. And the reason is that the tax rules in countries like the United Kingdom and certainly like the United States would, in many cases, unintentionally wind up impeding these international transactions, wind up subjecting them to multiple layers of tax that are there because the rules have features in them that are trying to prevent tax avoidance and tax arbitrage of various types, but wind up creating excessive tax burdens if taxpayers don't do something about it. Look, I teach tax law. There's a lot of effort that goes into tax planning, especially for high-value transactions, foreign direct big investment projects and things like that. Why are people doing all this tax planning? Obviously, it's to try to avoid paying taxes. That's what tax planning is. What are the taxes they're trying to avoid? Those taxes are often things where taxpayers can get caught in situations that governments don't really intend. But the interaction of the rules and the complexity of the transactions involved winds up creating a situation where you trigger a lot of tax liability. The governments don't really want that. The rules are there for another purpose. But a lot of tax planning is to avoid getting into a situation that no one really intended the taxpayer to be in the first place. But it takes planning if you have complex transactions in order to avoid that. The international financial centers facilitate that kind of planning. And as a result, you wind up avoiding the overtaxation of these international investments. If you didn't allow people to route transactions through international financial centers, mind you, I'm not sure exactly how you would draft rules that would not allow people to do that, but say you did, what would happen? What would happen is that there would be downward pressure on tax rates in general. Governments would not be able to maintain the kind of tax policies that they have now. I think many of them don't even realize that that's why they're able to maintain the tax policies that they have now. But if you didn't allow international investors to use international financial centers, here's what the theory says and the evidence. Governments would have to start reducing their corporate tax rates and change other aspects of tax-based definitions, because otherwise their investment flows would start to dry up. And the reason they would start to dry up is because the multiple interactions of the existing tax rules would be unsustainable in that environment. That you would have to change a whole slew of your rules and your rates in order to accommodate the financial realities of international investment. So, that's a very important function of international financial centers. I think often invisible, but in some ways it allows governments to maintain the tax policies that they want to have by providing this out for this planning opportunity for investors that wouldn't be there otherwise, or would have to be recreated in another way if you didn't route the transactions through the financial centers. Of course, there are many other issues that are raised with international financial centers. There are issues about transparency. As mentioned, there have been quite a few developments over the last decade in that most of those developments extremely beneficial. And there are issues about, still there are issues about to what extent do taxpayers fully comply with their home country rules when they have deposits really in any jurisdiction, including home jurisdictions. And that's always a struggle, obviously, for tax policy, because taxpayers would prefer not to pay tax if they can avoid it, and that's what people do. But that's true really wherever deposits are located, including, of course, in home jurisdictions. I can tell you what the evidence has to say about the international financial centers. Some of the evidence is about, in what jurisdictions, some of the evidence is about the characteristics of the financial centers themselves, which is, if you look around the world, what countries and territories are international financial centers? They tend to have small populations. Not every place, but generally speaking, many of these jurisdictions are islands. They have small populations. They have slightly above world average incomes. They're not, fabulously wealthy places by and large, but they're not particularly poor either. The average incomes of international financial centers are about twice the world average, which, again, doesn't put you in the category of the United Kingdom or anything, but it doesn't put you in abject poverty either. And the other characteristic, interestingly, is international financial centers score very highly on World Bank governance indexes. The World Bank has this classification of countries, I think very, it's generally accepted as a high-quality classification of governments in terms of democratic accountability, freedom of the media, absence of corruption, all of these characteristics of good governance. Of course, governance is always a little bit of a controversial subject, but these are generally accepted measures of governance. And international financial centers score very highly on that, even relative to, even after controlling for other characteristics such as their incomes. High-income countries tend to score very well in governance because good governance, is associated with having higher incomes and better economies. But these international financial centers do as well, even relative to their incomes, score very highly. And so, in some sense, the financial centers, probably would not be very successful if they were not well governed. That is, who would want to commit a lot of resources to a jurisdiction that you didn't trust? But in another sense, offer the rest of the world, and frankly, a lot of the world is not very well governed. It's one more piece of evidence, as though we needed it, about the benefits of good governance. That is, it's true that good governance is associated with having greater prosperity. It's also associated with having a better life. But for countries that don't have good governance, you can look around the world and see there are a lot of things that we don't have and can't have until we do have good governance. One of the things is you really can't attract significant amounts of foreign capital until you reform your governance, and the financial centers offer evidence of that. There's other evidence too. I know that this is a very controversial area, and it's a complicated area too. Those of us who've been steeped in it for many years forget how complicated these transactions appear to others, and how complicated these issues are. What I would say is the following. We've gotten pretty comfortable with the idea that well-functioning free markets contribute to prosperity. We've gotten pretty comfortable with that idea. We've had a bad experience in the last year and a half. That doesn't change the central message. It's still true today, right now, March 2010, that the places that are rich in the world are the ones that have embraced capitalism and done it well. And the places that are not rich in the world are the ones that haven't. And it's really about that simple. That correlation, is true through the crisis and through everything else. Well, capitalism is a hard message to swallow, and what certainly was in the early decades of capitalism. Why? Because as the old saying goes, under capitalism, man exploits man, and that's a hard message. However, we've gotten used to it, and the reason we've gotten used to it is A, it's true that capitalism leads to prosperity, and B, the evidence is overwhelming. It's just overwhelming. So we know that now. Well, if you believe in markets, if you think that free markets, are the kind of thing that contributes to prosperity, then it shouldn't surprise somebody that, jurisdictions that serve to facilitate market transactions contribute to prosperity. I mean, it's a pretty straightforward economic proposition, but it's not just a proposition. There's ample evidence for it too. And really what the report does is lay out what we've seen of the quantitative evidence of it. So if people have questions about that, I'd be happy to answer.
Yeah, let's start with questions in threes, perhaps. Who'd like to begin? Yeah, there.
My name is John Wilson. I'm a research fellow here, but in my previous career I worked for Financial Times, where I used to write about these issues, and I think some really interesting British issues about these. People need to think about the role of private entities in particular, which are actually an appendage of the City of London, really, and they help the City of London. When sometimes the City of London set up an investment strategy, they can say, well, we have to have a branch over the Jersey, go to the Isle of Man, and help people with this, part of the portfolio. I think another issue for us Europeans is what's happened with Germany buying stolen information, which now every other country has been buying from Liechtenstein, which I think is appallingly shocking, which I'm ashamed to say my former employer has endorsed in its leader. Because it seems to me that the point you can make about taxes, so long as it's paid at the end of the chain, that's what matters. It actually eventually emerges from the financial system to be either spent or invested or whatever. But the question I want to ask you about really is transparency, because I do have some queries on this. I mean, for example, while the European Union has forced offshore financial centres to find out where their investors live and make sure they're paying tax one way or the other on their income, there's still a whole lot of other investment gains which aren't taxed. That just seems to me anomalous, really. And the only reason that could possibly be is because people are avoiding tax. The second point is structured finance. And again, particularly the Enron case, but I think we've had it again this time around. I mean, all the G20 blamed the offshore financial centre, which is complete nonsense. But the transparency of the international financial system was made harder to understand because you could see the offshore, off-balance sheet vehicles were being located in international financial centres where they weren't so transparent. And then the final thing is IP. They're all going into IP registration in a big way in the crown dependencies. And again, it seems to me that there's probably some element of avoiding the levels of taxation you have on IP in offshore centres. And whether that's a good thing or not, I don't know. But just on transparency, do you think there's more that the IRC and OFC should do to increase the transparency?
Well, that's three questions there.
Yeah.
So well, thank you for those questions. There's quite a bit there. I want to make sure I touch on it all. On the intellectual property, the issue there is, assuming the intellectual property is not actually developed in the financial centers, which occasionally it is, but a lot of it isn't. The issue there is how the government's involved in the places where the intellectual property is developed, how they treat the outbound transfers of the property. I'm not as familiar with the UK rules as I am with the United States rules, and we've had some evolution of the US rules in that. It would be an understatement to say that the governments involved are very aware of this set of issues. As long as the outbound transfers of intellectual property are treated properly, that is, you tax the gain if there is a gain on it at the time of transfer, the transaction is fine. There's nothing to be concerned about. The issue is how you treat the outbound transfers, and their governments really have to develop an appropriate set of rules. In the United States, those rules have been, evolved over time. There's some controversy right now about what are called the cost-sharing rules, and that may be what is in play here as well, which is if you have foreign entities that pay for part of the development of the intellectual property, then of course they get the benefits of the intellectual property. But the key thing is that the prices be done correctly. And there is struggle there in determining what the right prices are, because many of these transactions there really aren't comparable transactions that you can point to, and so it makes it difficult to know whether you're choosing a price that's too high or too low. The issues are pretty straightforward, which is typically the taxpayers prefer to choose a price that allocates as much of the profit as possible to a low tax jurisdiction, and the high tax governments want to choose prices that go the other way, and then you have a negotiation about how it works. If a government tax authority is doing its job properly, the places where the IP is developed, I don't think there should be a problem. But that does assume that the government's doing its job properly. And I have no reason to think the UK government wouldn't do its job properly on that, but it does require that for sure. I mean, again, all of tax enforcement requires the government to do its job right. This is just one more example. You know, on the transparency and the offshore entities, the interesting thing about the Enron case was that, you know, Enron involved, among other things, fraud on the part of the corporate executives. It's considered an anomalous case in that that level of fraud is, you know, it's breathtaking and it's just very, very unusual. The interesting thing about Enron was that the tax avoidance that they were doing in some of the international financial centers was to trying to avoid paying tax on profits they hadn't actually earned. That is, Enron, you know, didn't have profits. They wanted to report that they did so that the executives could skim off some of that money. But then in the process, under US rules, you would trigger tax liabilities that the company didn't actually owe. You know, because we have an income tax, and if you don't have income, you don't have to pay it. Enron had losses, in fact. And so, but they were reporting profits, and therefore they had to gin up these tax avoidance schemes to try to reduce the obligation on these fictitious profits. When it all unwound, when it all came to light, you know, and unwound, the US government did an audit of Enron. Actually, the Joint Committee on Taxation Congress has the authority to do an audit on something like that. It was a long and exhaustive audit. I think people thought that with all of these offshore entities that Enron had, the reason they did the audit was they thought that they would collect more tax, you know, from them when this all came to light. And actually what happened in the end was Enron got a refund of previously paid taxes because in fact they hadn't earned, you know, the money that they were reporting. Now, was that something to do with offshore entities in particular? No, it was, you know, fraudulent activity on the part of these executives, and that fraud would have, we'll never know, but that fraud would have took place right onshore, you know, when they were reporting profits they hadn't really earned. Is there a potential problem of transparency? Of course there is. You know, we need to have transparency. We need to have information exchange agreements. And providentially, we're getting information exchange agreements. The whole world doesn't have information exchange agreements with everybody. There's an interesting question about whether there might be circumstances with, you know, highly corrupt, oppressive governments, whether in fact, you know, it makes things better to exchange full information with some of those. However, as a general matter, exchange of information to permit appropriate tax enforcement is, you know, highly desirable and fortunately is happening. Is there too much opacity still is a question. And that's an interesting question. There's more is, you know, with countries like the United Kingdom, you know, and its agreements with others, more is better with information exchange. I will say, speaking now from the United States, information exchange is a two-way, in concept, it's supposed to be a two-way flow, and we would do better to provide more information, you know, going outbound as a way of encouraging others to give us information going inbound. I will say, you know, information, I guess what I want to say is that information exchange is not merely a matter of financial centers providing information to, you know, G7 countries, but the other way around too. When the US insisted that, you know, UBS did all of these, you know, unconscionable things with their American clients, and it came out, and the United States demanded a lot of information from the Swiss. An interesting question would have been, had the tables been turned and Switzerland asked for the same information from the United States, you know, US Bank, Wells Fargo Bank, or something like that, would we have provided it? And of course, that didn't happen, so we don't know, you know, what the US would have done. But I think it's a real question that, you know, what we demanded of others, what our reaction would be if some other country demanded of us. You know, if we're going to demand information, then we should be prepared to provide the same information to others.
You talk about more is better. Are there any limits to this?
that you see?
Well, the question, you know, the question that people raise is, suppose that Robert Mugabe's government in Zimbabwe wanted information on every foreign financial transaction of any Zimbabwean. Would it be good for the world to provide that information to them? That's the question, and I think that's an open question.
Yes, we'll go here, and then over to the back, and then here.
I also have, I'm afraid, 3 in 1 question. You've sort of hit the issue of transparency, but not very well, if I can be honest, because you've been looking at data, and throughout the entire period in which your data has been collected, that has been almost total capacity within the locations in which you've been surveying. I mean, there is tiny chinks now towards transparency, but it is tiny. And we're talking about work which was largely opaque. You say that markets work, and yet you're promoting places which create opacity, which is the absolute enemy of efficient allocation of resources within markets. There seems to be a fundamental contradiction within your work as a result. Would you like to comment on how you can deal with that one? Secondly, banking. You say we have better banking markets when they are near offshore centres. Well, actually, I'd argue, again, you've got your direction of flow exactly wrong, because markets, the banking markets are closed. There is no chance of a new entrant in the banking market. These are oligopolistic markets at best. They have monopolistic charging in many cases, particularly to SMEs and private individuals. And in fact, the offshore centres are there for them to siphon off their profits, and it's quite clear from a great deal of work, some of which I've contributed to, I admit, that shows that they are removing their profits in that way. So in fact, they're not contributing to the effectiveness of markets. They're actually reinforcing the monopoly control of the banking market. But thirdly, your argument about the fact that you benefit from the near location of these, again, is completely the direction of travel you're going in. Because in fact, those places are where they are precisely because they are near places that are successful. They don't contribute to the success of the UK, they siphon off the success of the UK or Cayman or wherever else. They actually are there to undermine the regulation of the UK, quite deliberately, that is their purpose. They are there to undermine the tax base of the UK. They're there to undermine the democracy of the UK, because that is what tax competition is about. It is removing the right of the government to fulfil its own mandate with regard to its own internal choices. You argue for international tax competition that is actually anti-democratic. And the whole process of these places is actually to suck the lifeblood out of the UK, or the US, or the German, or the French economy. And so, in fact, they are located nearby to be able to achieve that result. They don't contribute to it. And let me draw the final fallacy out. You talk about the capital that is in these places, but you don't talk about where the capital that is in these places comes from, because you're ignoring the very point. They have no capital at all. There is nothing there. They are merely booking centres. Therefore, that money comes out of the UK, the US, or maybe China, and some like the British Virgin Islands, but they have nothing to give. This, therefore, is round-tripping, using opacity to undermine the tax base of other places. So all your arguments flow in completely the wrong direction.
I think we'll probably finish. We'll get to come to the other questions after.
Sure. Look, I really would like to address those questions, and if you don't mind, I noted, you're Mr. Murphy, right? I noticed on your website this morning that you said you wouldn't find my answers convincing. I'm hoping to disappoint you. So here's, you know, in terms of, it's certainly true that we look at, you know, I look at data, other scholars look at data. Data are what are reported. Now, we try really hard to piece together information that's available, but obviously you only get to see what is reported. However, that doesn't change some of the evidence that we really can look at. That is, if we ask the question, how much foreign direct investment by multinational firms into the United Kingdom, United States, France, whatever, how does that appear to be affected by transactions with, you know, proximity to and reported transactions with international financial centers? That we really can analyze, because we really do have data on foreign direct investment and, you know, economic activity in the United States, in the United Kingdom. And the difficulty of tracing, you know, certainly in the past, the difficulty of tracing transactions through international financial centers doesn't change our ability to analyze their impact on the real activities of high-income countries. And so, I have to disagree with you there that I think we do have high quality data on that, and I and others have looked at it. On the banking issue, which was your second point, by the way, that study, those studies actually are not mine. I'm an informed reader of them, but Andy Rose, who's at University of California, Berkeley, and Matt Spiegel at the Federal Reserve Bank are the ones who pioneered that research. I agree with you that there are a lot of bad banking sectors out there, but it is true that the evidence that they report is accurate, that even though those financial sectors have trouble, they are more competitive. The ones that are more proximate to these financial centers are more competitive. In that sense, it goes the other way from what you were saying. That is, the truly impacted places are not the ones that appear to be close to or have a lot of transactions with the financial centers. It's the financial centers are the ones that are, if a financial center is nearby and some country with a impacted banking sector, and there is the potential for transactions there, those are the banking sectors that do better than the other ones, is what the evidence says. Look, when someone like me talks about what the evidence says, it's an average. It's a statement about an average. It's not true of every place. And I'm sure there are places where the problems that you describe, you accurately describe the problems. But what the Rose and Spiegel evidence is doing is pointing to what the central tendency is in the information that we have. And the central tendency is the other way around. In terms of how to think about market transactions and places with opaque transactions. It's certainly true that if a jurisdiction facilitates secrecy, doesn't exchange information, and exists to try to undermine the tax system of other countries, I agree that would not be very desirable for the other countries. I totally agree with that. But here's the thing, in today's world right now, what you're getting is, for one thing, a lot of information exchange. For a second, you have these agreements being signed, and more are being signed all the time. If you're an investor who's interested in anonymity, now is the time to be very nervous about that, because you don't know whether and to what extent your information is going to be exchanged in the future. Take the Liechtenstein, case of the rogue employee selling the data to the German government. This is a one-off sort of thing. However, now is not a very good era for those who seek, that kind of secrecy and method of tax evasion. I'm not saying it never works. I'm sure it does work sometimes, but you have to be pretty steely if that's your plan, because everyone knows there is the prospect of being revealed, and so I think it's a lot harder. Here's what we do know, which is that there are a lot of explicit above-board transactions that go through these jurisdictions that seem to serve a lubricating function for capital flows. Of course, the capital flows of the Netherlands Antilles are not a bunch of Netherlands Antilles people saving their nickels, and investing them in the United States. That's, there might be a little bit of that, but that's not what the capital flows through that place are about. There are people from other jurisdictions, as you say, routing transactions there and doing some, accounting and legal work or whatever, but primarily taking capital from elsewhere and rerouting it somewhere else, sure. The question is whether that's all bad. Is financial intermediation bad? You can talk yourself into, in an earlier era, people talked themselves into the idea that it was evil, to earn interest on loans. That somehow God meant us to work in the fields or something and get paid for that, and people who saved and loaned to others shouldn't get interest. But in the modern world, we understand that financial transactions actually have the potential to make everybody better off. And look around the world. Where are people well off? Where are they? It's places like this. That's where they're well off. And where are they poor? places where you don't have free markets and you don't have well-functioning financial markets. If these things get in the way of well-functioning financial markets, I'm completely against them. But if they help financial markets, then, if you want economies to be wealthy, then you should welcome their efforts. And the evidence that we've got is that they actually help the functioning of financial markets and thereby contribute to economic activity.
Should we have some more questions? Yeah, over the back, and then
Simon
oh,
Park.
and one on here, sorry. So,
Simon Park from Bloomberg News. You said that capitalism is a hard message to swallow because it's exploitative. Is capitalism really necessarily exploitative?
I was speaking kind of facetiously, and in that what I meant was capitalism was a hard message. I may have said is, but I meant was.
Twice.
I erred twice.
If you were speaking facetiously, can you say what else you said was facetious?
Nothing else was facetious. No, I'm quite sincere, but capitalism, look, Adam Smith, lived in Britain and published The Wealth of Nations almost 250 years ago. That was a message of capitalism.
But he didn't say it was exploitative.
I don't think it's exploitative.
A collaboration between the butcher, the baker, and the candlestick maker that was a contributed to an increase in everyone's wealth. So why?
I don't believe it's exploitative.
But you said it was.
Well, then I made a mistake.
Well, maybe that's why people are confused about tax havens and your core message.
I think it's okay. We said there's one mistake, and he's obviously cleared that up.
I'm a professional economist. I think free markets make everybody better off. And as I've said, I think several times, look around the world. The places with free markets, people are better off.
So capitalism shouldn't be a hard message to swallow then, should it?
It shouldn't if people look at the evidence. But I think that originally when the idea was proposed, it was a hard message. And intuitively, for many people, many of the messages of economics are difficult to swallow, even though they're true. So let me give you another example, the case for free trade. Does free trade make a country better off? It certainly does. Is that an easy message for people to understand at times? No, it isn't. Because you can readily talk yourself into the idea that we shouldn't allow free trade because other people will get our industries. Or look, Britain had export bounties at one point in its history. Taxes on exports. Why? Because the thinking was, why should you give other people your stuff? You should keep it for yourself. That was the thinking. But of course, it's wrong. I mean, that is, you make yourself better off through trade, and we understand that now. But I would challenge many people who believe in free trade actually to reproduce the argument for it, which is not a simple argument, however true it may be. So look, I erred. Capitalism may have seemed exploitative to people. However, in the end, it makes people wealthier, and you look around the world, that's what you see.
Hi, my name's Martin. I'm from an international development agency called ActionAid.
Called
ActionAid. We're interested in helping governments in developing countries to increase the amount of revenue raised from tax that are dependent on aid so much. I want to understand a bit more this question about the evidence base that explains how proximity of a developing country to an offshore financial centre leads to an increase in investment flows and economic activity. Because I can understand that the evidence base shows a correlation between those two things. But what I wasn't sure of was what the evidence is for the causative role that they play. And I think the point made over here was that perhaps the causation moves in a direction. I'd be interested to know what the evidence is that shows that it goes in a particular way.
That's an excellent question. And I sort of didn't get into the guts of how the analysis is done in my research, but I'd be happy to explain that. And this is often the case. You can look at a correlation between two things, but it doesn't mean that, if two things happen to go together in the data, it doesn't mean that A causes B or B causes A necessarily. The question is, how would you be able to tease that out? And there are studies that address themselves to exactly this question. And in order to analyze it, what you need to do is to find, and actually in my report I have some discussion of this issue, you need to find factors that help you predict at least one of the two pieces here. That is, if you can find reasons why international financial centers are located in particular places. And if, in a hypothetical world, if they were somehow randomly distributed around the world, then you could look at the impact of the random distribution and then say, oh, well, if randomly one was assigned here, then are the places that are nearby, do they have better economic performance or greater investment, higher incomes, whatever, as a consequence? That would be the goal. Of course, they're not randomly distributed, as your question notes. So how do we try to tease out this effect? The study that I like best on this is one that I did with two co-authors. Well, okay, I won't hold back. One I did with two co-authors at Harvard, and Mihir Desai and Fritz Foley. And what my co-authors and I did in that study was to look at countries around the world and ask the following question. We do have factors that predict investment in different countries. And of course, the developing world doesn't get anywhere near the levels of investment that the developed world gets, but they do get some. So we do have factors that help predict investments in investments in really any country. And the question is, for firms that do investments in these countries, is that associated with routing transactions through international financial centers? This question. And the answer is yes. You do find that. That is, it shouldn't surprise us that if a multinational firm, does an investment in some location, that they might also have transactions with a nearby financial center to help facilitate that investment. That probably shouldn't surprise us, and the evidence actually points to that. And we do have what are called instruments in order to predict the foreign direct investment and discover that those predictors are correlated with the use of financial centers. Okay, what does that imply, however? If by investing in a place you also have demand for transactions with financial centers, it turns out that in theory, that says that the availability of financial centers triggers investment, makes it less expensive. That is, if A leads to B, then in this case B should lead to A, because it's actually, well, okay, I can give you the reference. It's because if they go together, then if you make it easier to route transactions through the one, then it must. If by doing a lot of investment, it increases your demand for the use of financial centers, it follows that more ready availability of financial centers will lead to more investment. I mean, the theory is actually unambiguous on that. And so the way that people have parsed the evidence is that way, is actually looking at it indirectly and then applying the theory to draw the inference. It's something that, it takes, I could go into this in some detail, but that's how we do it. It's indirect, but it's actually, to those of us in the academy, very persuasive method, because it's the best that we can do under those circumstances. But again, just intuitively, if you realize that when investment is done, people want to do it, routing it through these centers, then it has to follow that the availability of the centers makes it more attractive to do the investment.
So I guess, just as a very quick follow-up.
Yeah.
Imagine I'm a business, I'm
not either.
And I want to invest in a particular thing where I can invest in one country, which is near a financial center, in one country. Now, from a development perspective, I'm actually less interested in which of those countries the businessman chooses to invest in, and more the total amount of investment going to developed countries altogether.
Sure.
And what I'm not sure of, though, is whether the prevalence of offshore financial centers increases the total amount, whether it simply influences choices about where it goes, because that, from a development perspective, is less interesting.
That's interesting, and that's another excellent point, I think. Here, you're kind of saying, if I could rephrase it in terms I'm familiar with, if we have this partial equilibrium effect, that is, one kind of market at a time, does it translate to the general equilibrium, that is, to all the markets at the same time? That is, does it follow that, you sometimes have subnational jurisdictions, like US states, will offer tax benefits for investment and get more investment as a result. And the question is often asked, does that lead to more investment in the United States in general, or has it led to investments not going to California and instead going to Ohio because Ohio offered the incentive? Usually what we find in those cases is it's some combination of the two. That is, that you do get divergence from other places. However, it would be very unusual for the divergence to be complete. That is, it's generally some combination of the two. The difficulty is, how do we actually use the evidence to figure out how much of a combination it is? And that honestly hasn't been done in this case. To be perfectly honest with you, it hasn't been done. It's an incredibly hard problem. That's the reason. 2% of my brain at any one moment is trying to figure out how to actually analyze that. I haven't done it, but nobody else has done it either. And the reason we haven't done it is we haven't figured out how exactly. I can tell you that in the cases where I have seen it done, like in the American State case, it winds up some of diverting from other places and some of contributing to the overall level. But exactly how much, that's conjecture.
So if I ask my question, are offshore financial centres good for developing countries as a whole? The answer is we're not quite sure.
Well, I think that's a little too nihilistic, actually. We don't know how much they are. That I readily grant you. But it would be amazing if actually the effect was pure divergence, because you almost never, pure pushing from one to the other, you almost never see that in these cases. You see, some, and then some of increasing the total amount.
Then one follow-up here.
Hi, Dr. Christensen from the Tax Justice Network. Nice to see you in person after reading your papers for many, many years.
Oh, thank you.
Couple or several points. First of all, I've drawn your attention to the Royal Commission of Inquiry by the Norwegian government, which was published last year, which addressed the question that was put to you about impacts in developing countries. That report came to a very unequivocal finding, which was the opposite to your finding.
I'm familiar with that report, yes.
So you're familiar with it?
I am, yes.
But you didn't mention it.
I don't think it has a factual basis, honestly.
For the very reason, as we know, there is very little factual information.
But there is.
I want to pick up on...
oh, no, I'm sorry. I want to interrupt anymore.
Okay. Come back to you. First of all, on the issue of governance, you're probably familiar with, as you rightly said, the governance debate is an emerging debate, and particularly on the issue of transparency and lack thereof. We made a contribution to it last year in the form of a financial secrecy index, which ranked 60 jurisdictions according to their opacity. I'm sure you're familiar with that. USA came out at the top.
We're number one?
You are number one in terms of lack of cooperation, lack of transparency, and scale of operation. I think it's very important. Now you link this to the fact that the USA continues to resist attempts from other countries to achieve information exchange agreements. Mexico, for example, has invited or requested the Trump administration to enter into automatic information exchange agreement. The administration so far has not responded. Do you think that the US should now respond positively, engage in automatic information exchange, and following on from that, would you agree with our position that automatic information exchange is the standard that the world should now aim at?
So there were two questions.
And then a question.
Sure. On the Norwegian report, I am familiar with the report. I think that the right way to think about this set of issues is to look at whatever available evidence there is. And I would say that, look, there's better and worse evidence on these questions. What I have shared with you, in this report that I did, is the highest quality academic evidence I could find, and I think anybody else could find.
Much of your work depends on international data. So I have asked IMF and team others to look at foreign direct investment flows to separate the non-trade element, which was referred to earlier, from the genuine cross-border investment flows. They say they're not capable of doing this. but they accept that there's a very substantial amount. And that tends to undermine your data sets and business you're using. As an economist myself, I think the lack of evidence, or lack of data, the paucity of empirical research in this area is a major impediment to all of our research. And we all agree on that. But it does mean that there are many question marks hanging over your research findings.
I'd be delighted to address them one by one if you have question marks. You know, that is, I've worked with these data for longer than I think anyone you can name. And
myself, 35 years.
Want to talk about data? I can.
I've been in this field for 35 years. So.
Well, I've been working. Yeah, doesn't matter. I'm sure you have. So anyway, the Norwegian report. You know, look, I don't feel. I usually respond to other academics and you know, people who are specialists in this area. So the Norwegian government produced this report. I read it, but you know, I don't generally respond to things like that. So you know, it's.
No, sorry, these are academics who got that report.
Oh, I know them all.
You know them all.
Sure. You know, it's there is a lot of evidence in this area. Some of it is better than others, and the stuff that I summarized in the report that you have is better than other. Look, many of these studies are not by me, but you know, we distinguish between, you know, along the lines that you and I were just discussing. I forgot your name. I'm sorry. Yeah. No, you were asking the right questions. These are exactly the right kind of questions to ask of anyone who does studies in this area. And I would challenge the authors of the Norwegian report to answer his questions, because they are the right questions to be asking. How convincing is this evidence? How did you come to the conclusions that you have? On what basis? Do you have the right instruments to tease the difference between correlations and cause and effect? Those are exactly, and are your results partial equilibrium or general equilibrium? Those are exactly the right questions to be asking. And those are the questions to ask about that Norwegian report. So, you know, anyway, those are questions. You know, I'm sorry, and your second, you had a comment and then a question. Oh, automatic information exchange. Well, I'm completely in favor of more information exchange, and I would be in favor of the United States doing much more information exchange than we do. I think I mentioned that earlier, actually. Yes, certainly if we're going to ask other people to exchange information with us.
The specific issue here, of course, is
whether it's automatic.
Automatic and on request.
Sure.
Because the treaties that have been signed together are almost entirely on this model, which we know isn't working. My own home island, Jersey, accepted in the last 4 years, less than half a dozen exchanges between USA and Jersey, not a major deterrent. So I think in talking about information exchange, we need to get down to the conclusion of that's involved, to talk about what works, what doesn't.
Well, as you say, I much prefer to have an evidence-based discussion, if at all possible. And when we get down to the level of which method of information exchange is the best method, I don't know that we have the information that we need, you know, the data that we need in order to address what is the best method. So honestly, I don't have a position on which way we exchange information, just that I would like to see, you know, it more readily happen, including definitely from countries like the United States or the UK. So, you know, in that, I agree with you. But if the question is, you know, do I embrace automatic information exchange? I don't have enough information to know whether that's the best method of doing it.
I don't think you can entirely dismiss sort of bilateral agreements if people like the OECD and other kind of international relations are appreciating whether or not I think automatic is another thing that would be useful.
Sorry.
Any final comments? I think we've kind of had quite an active debate today, trying to understand more about these issues, which inevitably there are going to be some difficulties with the data and trying to understand exact mechanisms behind it. Because none of these issues are easy, they are all complicated. But I'm really, really pleased to have had Jim Hines here today. I've really enjoyed myself. I hope you have too. I'd like to very much thank you.